Hi, everyone. I am here again with my friend Adam Tooney from the Resolve Group. Hi there.
Hey, Nikki, how are you?
Good, good, good.
Good.
You had a question for me.
I did. So I was reading an article in the Wall Street Journal last week, and it looks like the Fed has something come up on the horizon, and I wanted you to kind of to speak to that because it's
Yeah,
good news, right?
we love the Fed.
Yeah.
Um, sort of not. So yes, the Fed was very active last year. They raised short-term rates, as you all know, 3/4 of a point almost every meeting. It was brutal. It was one of the biggest raises in a very, very short time because inflation, because number of things coming out of a pandemic. We had a lot of aggressive inflation news. So when the Fed raises short-term rates, they're trying to make the overnight borrowing costs more expensive so that people buy less, and so the prices come back down. That's the point of the Fed's raising the short-term rates. Why do we care in the mortgage market? Because we look at long-term rates. It's they are hedging against inflation or trying to catch up with the inflation so that the long-term market can settle. And we've seen that work. We've seen interest rates come off their highs. So we were talking sixes and sevens just a few months ago in interest rates, and we are now talking fives, some sixes still, and even some fours in some cases. So rates have settled. The Feds have done their job. Hopefully inflation looks like it's easing. And so the news out there right now is that in February, they're likely to increase again, but only by a quarter. And again in March by a quarter. Those are the current indicators. So we think we're at the end of the aggressive raises, and the market likes that. So when I say it's priced in, that means that the mortgage market, which the bond market that we follow, the 10-year bond, is the people who trade those bonds are saying, okay, the market in the future is not going to be as high. So it settles us in the mortgage world, which we like. So,
But
you
typically
didn't.
the inverse happens, right? So
Exactly.
Fed increases those short-term rates, but then we'll hopefully see a drop in long-term interest rates for mortgages.
Exactly.
That's
Because the
okay.
short-term raises are trying to curb inflation. If they weren't doing any of this, then we would see rates, just long-term rates, going up because there's nobody, watching the shop. It's just getting out of control. Well, they are watching it. They've aggressively raised. Some could argue maybe too late, but that's a whole different conversation. But yes, it's good for us. I think we're off our highs. Will we ever see 2.5% fixed rates? Probably not, and I hope we never see a global pandemic again. But a good steady 30-year fix between 4.5 and 5.5, 6 is a good place. If you were going to put your money away for 30 years, you'd probably want a rate of return of somewhere around there anyway. So that's a good way to flip it and think about it as an investor. It helps you get settled with those rates.
One last question, and if you purchased a house recently, you think rates are going down, does it sound like a good idea and within the next 12 months to do a refi if that is a possibility?
Mm-hmm. Absolutely. And here's the challenge: is you never know when you're at the bottom. So
Yeah.
you might refinance and then they go down. You're like, well, shoot, I shouldn't have refinanced. Well, you didn't know that. You didn't have a crystal ball. And so you may end up refinancing 1 or 2 times. I mean, in the last 10 years, people have refinanced 2, 3, 4 times. You just don't know where that bottom is. If it makes sense and the closing costs pay off in a short amount of time, do it. And you may have to do it a couple times. It's just because none of us know where that bottom is.
Well, that's super helpful information, and it sounds very promising. So thank you for your time, Nikki,
You
and
are
looking forward to
welcome.
seeing you next week.
Yes, good, good. Absolutely. See you soon, Adam. Take care.
Thanks, Nikki.
Bye.